Ever wondered which ETF could take your $100,000 to the next level? An ETF that can turn it into a $10 million return. Sound impossible? Today, I'll be breaking down two powerful ETFs, VOO and QQQ, to see which one can make that dream a reality. I'll show you what sets VOO and QQQ apart, from their strategies for generating returns to their potential risks. I'll break down each aspect to give you a clear picture of which might suit your investment journey better. I'll show you a side-by-side look at what happens when you invest $100,000 in each of these ETFs over the long haul. Spoiler alert, there's a difference of $12 million in valuation. Before we dive into the specifics of which ETF is better, let's set the stage with some background information about these two powerhouse funds. First, let's start with VOO, the Vanguard S&P 500 ETF. Introduced by Vanguard in 2010, it aims to track the performance of the S&P 500 index, which is a benchmark for the U.S. stock market. VOO provides investors with exposure to 500 of the largest U.S. companies, making it a fantastic choice for those looking to invest in a broad, diversified portfolio. With over $1 trillion in assets under management, VOO is one of the largest and most cost-effective ETFs available. On the other hand, we have the Invesco QQQ Trust, often referred to simply as QQQ, which was launched in 1999 and tracks the NASDAQ 100 index. Unlike VOO, QQQ is heavily weighted towards technology and growth companies, giving it a distinct flavor. It includes 100 of the largest non-financial companies listed on the NASDAQ stock market. With over $280 billion in assets under management, QQQ is a favorite among investors looking to tap into the growth potential of tech giants like Apple, Microsoft, and Amazon. Now, investing wisely means understanding different ETFs like VOO and QQQ, and there are some major differences here. Let's break it down. First off, VOO stands out with its incredibly low expense ratio of just 0.03%. This means you're paying a mere 3 cents for every $1,000 invested, or just $30 on a $100,000 investment, making it a budget-friendly choice for passive investors. In contrast, QQQ has a higher expense ratio at 0.2%, which translates to about $200 on a $100,000 investment. As I always say, keeping costs low is key to maximizing your investment returns. But can this extra expense ratio mean that QQQ can outperform VOO? Wait till the end to find out. But the truth is, the expense ratio is not the only thing to note in an ETF. It's also important to see how diversified the ETFs are. Which brings us to our next chapter, VOO and QQQ holdings. Starting with VOO, its top holdings include some of the biggest names in the business world. At the top of the list, you'll find Apple, Microsoft, and Amazon, which are household names and leaders in their respective industries. However, there have been some shifts over time. For instance, Tesla has dropped in its ranking, while Berkshire Hathaway has risen. This shift is important because Berkshire Hathaway is considered a value stock, priced fairly compared to its earnings, while Tesla is seen as a growth stock with a high valuation based on its potential to expand. QQQ's top holdings are also dominated by tech giants, including Microsoft, Apple, Nvidia, and Amazon. Despite some differences in the bottom end of the table, it's striking how the top 6 to 8 holdings are the same for both ETFs. However, the weight of these top stocks is more significant in QQQ compared to VOO. This is because QQQ has fewer holdings, around 102 compared to VOO's 507. In QQQ, these top 8 stocks make up almost half the entire index, while in VOO, they make up about a third. This concentration means that QQQ is more exposed to the performance of these top companies, which can lead to higher volatility. The concentration of individual stocks in QQQ, particularly the heavy weighting of companies like Apple, means that when you invest in QQQ, a larger portion of your money goes into these top tech companies. This can be great during a tech boom, but it also means more risk if the tech sector faces challenges. Overall, these differences in holdings and their weights can lead to variations in performance between the two ETFs over time, despite their general similarities and long-term trends. In the end, I'll show you a side-by-side projection of both ETFs, and you'll see how this slight difference can end up being an overall difference of $12 million. Now that we've seen what's inside VOO and QQQ, let's take a closer look at their investment strategies. Understanding these strategies will help you see how each ETF aims to generate returns and manage risk. Starting with VOO, the Vanguard S&P 500 ETF follows a straightforward, passive investment strategy. It aims to replicate the performance of the S&P 500 index by holding the same stocks in the same proportions as the index. This strategy is known as indexing, and it's designed to match the market's performance rather than beat it. Because VOO is passively managed, it has very low operating costs. This is reflected in its low expense ratio of just 0.03%. On the other hand, QQQ, or the Invesco QQQ Trust, also uses a passive investment strategy, but with a different focus. QQQ tracks the NASDAQ 100 index, which is heavily weighted toward technology and growth companies. This index includes the largest non-financial companies listed on the NASDAQ Stock Exchange. Like VOO, QQQ aims to mirror the performance of its index by holding the same stocks. However, because the NASDAQ 100 is more concentrated in tech, QQQ's performance is more volatile, offering higher potential returns, but also higher risk. While both VOO and QQQ use passive strategies, the key difference lies in the indices they track. VOO's strategy of mirroring the S&P 500 means it benefits from the stability and diversification of 500 large U.S. companies across various sectors. This broad exposure helps mitigate risk and provides a buffer against market volatility. In contrast, QQQ's strategy of following the NASDAQ 100 means it's more focused on high-growth sectors like technology, which can lead to higher returns but also greater fluctuations. For investors, the choice between VOO and QQQ often comes down to your own personal risk tolerance and investment goals. If you're looking for steady, reliable growth with lower risk, VOO's diversified approach might be more appealing. However, if you're willing to accept more risk for the chance of higher returns, QQQ's focus on tech and growth could be the better option. So based on these strategies, let's see how they've performed in the past and what the future outlook looks like for these ETFs. Starting with the year-to-date returns, VOO has achieved a solid 15.3% return, which is slightly lower than QQQ's 16.76% return. This suggests that in the short term, VOO and QQQ both have performed relatively similarly. When we extend the timeline to 5 years, that picture starts to change. Over this period, QQQ has returned an impressive 153.63%, clearly outpacing VOO's 85.57% return. This indicates that QQQ has had a significant edge in recent years, driven largely by the strong performance of its tech-heavy holdings. Looking even further back, the 10-year performance comparison tells a compelling story. Over the past decade, QQQ has yielded over 410%, while VOO has delivered around 180%. This long-term data highlights QQQ's ability to generate substantial returns thanks to the robust growth of major tech companies like Apple, Microsoft, and Amazon. But is this growth alone enough to make it a winner? In the end, I'll show you whether this growth alone is enough to cross a $10 million valuation. Now, when considering an ETF for investment, it's important to look beyond just share price growth. Firstly, VOO has shown an average 10-year share price appreciation of 10.7%. Next up, we have the current dividend yield. VOO offers a dividend yield of 1.28%. Then there's the dividend growth, which stands at 7.14%. For QQQ, the figures look like this: current dividend yield of 0.5%, dividend growth rate of 9.93%, and an average share price appreciation of 17.82%. Now let's calculate John's potential earnings from a $100,000 initial investment based on all these figures. Starting with VOO, if John invests $100,000 in this ETF today, here's how his investment could grow based on historical performance and average returns. In the first year, a $100,000 investment in VOO is projected to grow to around $112,210. After 10 years, this investment could triple to approximately $310,926. And it gets better from there, because the power of compounding starts to show its effect over longer periods. After 20 years, John's investment could grow to about $937,228, and after 30 years, it could reach an impressive $2,766,034. In total, this ETF has the potential to add $2,666,034 to his initial investment, which includes $2,532,019 from the growth of stock, while $134,015 came from the dividends. The big question is, can QQQ beat that? Let's find out. With a $100,000 investment in QQQ, John's investment could grow to around $118,320 in the first year. After 10 years, this investment could five-fold to approximately $531,202. You see, the higher growth rate of QQQ starts to stand out over longer periods. After 20 years, John's investment could grow to about $2,774,601, already matching the VOO performance of 30 years. But it gets even better for QQQ in the long run. After 30 years, John's initial investment of $100,000 has the potential to reach a staggering $14,385,324. In total, this ETF has the potential to add $14,285,324 to his initial investment, which includes $14,220,335 from the growth of stock, while $64,990 came from the dividends. Now, if you want to know how to earn over $70,000 per month in dividends, click the video on the screen.